Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have completed 5 problems on valuation of goodwill. Short problems. In this video, 2 more short problems, that is 6th and 7th I'm going to finish. Then we'll start the main problems on valuation of goodwill. So in the previous videos, I have explained you about the meaning of the term goodwill, what are the features of goodwill, what is the need for calculating goodwill, why goodwill is calculated, and what are the methods of calculating goodwill. All this theory is very important. Not only problems, but also theory is important from examination point of view. For every type of examination, whether it is a university examination or any competitive examination, this theory is very important. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel. Select the subject Advanced Accounting 2023. Watch the video of valuation of goodwill. Be perfect about the concept, then you can understand the problems. So before starting the 6th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep the problems ready. Take the screenshot of the points written on the board, then I'll explain. Now, see the 6th problem. Problem number 6. The following are the profits of a business for 3 years. 2006, 50,000, 2007, 60,000, 2008, 70,000. So last 3 years profit are given 50,000, 60,000, 70,000. So we observe the profits are increasing every year. The capital employed was 4 lakh and the normal rate of return expected in similar business is 10%. This is the NRR, normal rate of return and capital employed. By using this capital employed and NRR, we can calculate normal profit. So that means this is the problem on super profit method. Then calculate goodwill by 2 years purchase of the average profits method. That is super profits method. Now, see carefully. Calculation of value of goodwill by super profit method. The profits are showing an increasing trend. So we calculate weighted average profit. If the profits are fluctuating, we can calculate simple average. But whenever it is showing an increasing or decreasing trend, then it is better to calculate weighted average. So here 2006, 7, 8, 50,000, 60,000, 70,000 increasing. So we have to give the weight 1, 2, 3, right? Now calculate the weighted profit, multiply the profit with the weights. So 50,000 into 1, 50,000, 60,000 into 2, 120, 70,000 into 3, 210. The total of weighted profits are 3,80,000. And what is the total of weights? 6. The weighted average profit, the formula is summation PW divided by summation W. PW stands for weighted profit and W stands for weight. So here 3,80,000 divided by 6, you get 63,333. This is the weighted average profit. No anticipated changes in future are given. Actually, the meaning of FMP, future maintainable profit, is past adjusted profit adjusted for future changes. Past average profit adjusted for future changes. So we have the past average profit, but we don't have any future anticipated changes. So whatever past average profit, that itself will be the FMP. So future maintainable profit is 63,333. Normal profit, capital employed into normal rate of return. The capital employed is given 4 lakh and normal rate of return 10%. So 4 lakh into 10%, 40,000 is the normal profit. And super profit, SP is equal to FMP minus NP. Future maintainable profit minus normal profit. So 63,333 minus 40,000, 23,333. This is the super profit. And goodwill is equal to super profit into number of years of purchase. So super profit 23,333. Number of years of purchase given in the problem. Goodwill is to be calculated for 2 years purchase, it is given. So multiply by 2. you will get 46,666. This is the value of the goodwill according to super profit method. That's all. This is the end of problem number 6. Now I am coming to problem number 7. For the following, calculate the value of goodwill at 3 years purchase of super profit. Again, just like the previous problem. Average capital employed in the business, 10 lakh. Sometimes it will be given average capital employed. Sometimes it will be given capital employed. So when we can't calculate the average capital employed, we can use the capital employed. Like in the previous problem. In the previous problem, directly capital employed was given, but no information is given regarding the average capital employed. That's why we have taken only capital employed. But in this problem, 7th problem, average capital employed is given. So we use average capital employed, 10 lakh. Net profit for the past 3 years, 135, 1,35,000, 1,60,000 and 1,40,000. Fluctuating. It is not showing increasing trend. It is fluctuating. So we calculate simple average. Add up the 3 profits divided by 3. Then rate of return expected 10% on capital employed. This is the normal rate of return. And fair remuneration to the organizers rupees 20,000 per annum. This is a future anticipated expense. The fair remuneration of the organizers 20,000 per annum. This is the expenditure to be incurred. So first we calculate average profit. From average profit, deduct this fair remuneration. Then we will get the FMP, future maintainable profit. Now, calculation of value of goodwill by super profit. Normal profit is equal to average capital employed into NRR. So, average capital employed is given 10 lakh. Normal rate of return 10%. So, 1 lakh rupees is the normal profit, NP. Now, we need FMP. So, simple average profit of last 3 years. Because the profits are fluctuating, that's why I am taking simple average. Add up the 3 profits, divide by 3. So, average profit comes to 1,45,000. Now, future anticipated expense. Fair remuneration of the organizers given in the problem 20,000. Deduct 20,000. So, 1,20,000 is the FMP, future maintainable profit. Now, super profit is equal to FMP minus NP. So, FMP 1,25,000, NP 1 lakh. So, 125 minus 1 lakh, you will get 25,000 as the super profit. Now, goodwill. The formula for goodwill is super profit into number of years of purchase. In the problem it is given, goodwill is to be calculated 3 years purchase. Specifically given 3 years purchase. So, super profit into 3. That is 25,000 into 3. You will get 75,000 is the value of goodwill. That's all. So, totally 7 short problems I have completed. Now I am coming to the main problems. But one suggestion to you. At the time of watching the videos, always keep a notebook, calculator, pen ready. When I explain some important points, make a note of it. Running notes you maintain. This will be very, very important for you to remember. Otherwise, simply watching and listening the videos, and listening the lecture does not, give more benefit. Maintain always the notes. Now I am coming to main problem. First main problem. Rahul Limited proposes to purchase the business carried on by Rupesh Limited. So Rupesh Limited wants to sell away his business, and this business is being purchased by Rahul Limited. Goodwill for this purpose is agreed to be valued at 3 years purchase of the weighted average profit of the past 4 years. Very simple. So we need to calculate the weighted average profit of the last 4 years, and that weighted average profit will be multiplied by 3 years purchase. We'll get the goodwill. The appropriate weights to be used are 2002, 1, 2003, 2, 2004, 3, 2005, 4. The 4 years are given 2002, 2003, 2004, 2005. The weights are 1, 2, 3, 4. The profits for these years are 2002, 1 lakh, 2003, 1,20,000, 2004, 1 lakh, 2005, 1,50,000. These are the profits. Now, next page it is given. On scrutiny of the accounts, the following matters are revealed. Now, A, B, C. When we study the accounts, when we scrutinize the accounts, some points have come out. What are the points? On 1st September 2004, a major repair was made in respect of the plant, incurring 30,000 rupees, which amount was charged to revenue. The said sum is agreed to be capitalized for goodwill calculation, subject to adjustment of depreciation of 10% per annum on reducing balance method. This is the adjustment which we have not considered. Now we have to consider this adjustment and calculate the correct profit. Actually, on 1st September 2004, a major repair was done. When major repair was done, it should be capitalized. That means the amount spent on major repairs should not be charged to revenue. It should be charged to the machinery only, capital asset only. But by mistake, what the accountant has done, he has charged that 30,000 rupees to profit and loss account. So what had happened? In 2004, the profit has been reduced because by mistake, 30,000 rupees was charged to P&L account. Actually, it should not be charged because it's a major repair, it's a capital expenditure, it should not be charged to revenue. So what we'll do? We'll add back 30,000 for the year 2004. In 2004, whatever is the profit of 2004 is 1 lakh. To that 1 lakh rupees, we add 30,000 because by mistake it was charged 30,000. Now there is a depreciation of 10% per annum on reducing balance method. Depreciation will be allowed as deduction. So in 2004 and 2005, we have to provide depreciation on this major repair, 30,000. 30,000, 10% is 3,000. Now this 3,000 is per annum. But when the major repair was done, it was done on 1st September. So September, October, November, December, 4 months. Actually for 4 months we have to calculate. For 4 months, because 1st September, October, November and December, for 4 months. So 30,000 into 10% into 4 by 12, you will get 1,000 depreciation. So 1,000 rupees depreciation should be charged in the year 2004. Now what is the WDV of that value? 30,000 minus 1,000, you will get 29,000. So 29,000 into 10%, 2,900 will be the depreciation for the next year, that is 2005. So what is the adjustment we have to make? In 2004, we have to add back 30,000. That is major repair, wrongly charged to revenue account. Now we are adding back. Now depreciation we have to deduct. How much? 1,000 rupees depreciation for 2003 and 2004, sorry. 1,000 depreciation for the year 2004 and 2,900 for depreciation 2005. That's it. First one over. Now second, B point. The closing stock for the year 2003 was overvalued by 10,000. In 2003, the closing stock was overvalued. Now remember, note it down. When the closing stock was more, the profit will also be more. There is direct relationship between closing stock and profit. Higher the closing stock, higher is the profit. So by mistake, we have overvalued the closing stock. So profit was overvalued in 2003. What will do? Deduct. Subtract the 10,000 rupees overvaluation of stock in 2003. Right? Now the closing stock of 2003 will become opening stock for the next year, 2004. 2004. So the closing stock of 2003 was wrong. So automatically opening stock of 2004 will also be wrong. That means opening stock of 2004 is overstated. When opening stock is overstated, profit will come down. There is inverse relationship between opening stock and profit. Higher the opening stock, lower will be the profit. Right? Whereas closing stock and profit, there is a direct relationship. Opening stock and profit, there is inverse relationship. So if you have taken more opening stock, then what will happen? The profit has come down. Now we have to add back. So ultimate effect, the closing stock of 2003 is overvalued. So deduct 2000 in 2003 and add overvalued of opening stock in 2004. So 10,000 will be deducted in 2003 and 10,000 will be added in 2004. That's it. Next one. To cover the management cost, an annual charge of 25,000 should be made for the purpose of goodwill valuation. Compute the value of goodwill. So every year 25,000 rupees annual management cost will be incurred. This is the future expenditure to be incurred. So now we deduct 25,000 every year. So before calculating the goodwill, we need the correct profit, adjusted profit. So unadjusted profit is given in the problem. So here I am calculating ascertainment of correct profit. So unadjusted profit are 1 lakh, 1,20,000, 1 lakh, 1,50,000. That is given in the problem. Now we'll make one by one adjustment. Add major repair wrongly charged to profit and loss account on 1st September 2004. 30,000 rupees major repair was done in 2004 and wrongly it is charged to profit and loss account. That's why our profit has decreased in 2004. Now we have to increase. So add 30,000. Now depreciation has to be provided on this major repair at the rate of 10% per annum on reducing balance method. So first of all 30,000 is the major repair. 10%. So 10% of 30,000, 3,000. But when this major repair was done on 1st September 2004. So September, October, November, December, 4 months. So here you can see depreciation on major repair 10% on WDV for 2003. 30,000, 10 by 100 into 4 by 12, you will get 1,000. So 1,000 depreciation we deduct here. Depreciation on major repair at 10% on WDV method, minus 1,000. Now, the same machinery will be carried over to the next year, that is 2005. The machine will be carried over to the next year. So, actually the expenditure incurred was 30,000 and depreciation provided during the first year was 1,000. So, what is the WDV, written down value? 29,000. On that 29,000, depreciation at 10%. So 29,000 into 10 by 100, 2,900 is the depreciation for the year 2005. Here, 2004, 2005. Again, one mistake is there. Here it is not 2003, it is 2004. And this is 2005. For 2005, cost is 30,000 less depreciation for the year 2004 is 1,000. So WDV is 29,000. 10% of 29,000, 2,900. Subtract. Now closing stock for the year 2003 was overvalued. When closing stock was overvalued, profit was also overvalued. Now we have to subtract. The overvaluation of closing stock will be subtracted. So minus closing stock of 2003 was overvalued. So minus 10,000. Now the closing stock of 2003 will become opening stock for 2004. So automatically when closing stock is overvalued, it means opening stock is overvalued for the next year. So when opening stock was overvalued, then profit was less. Now we have to add. So the same. Add opening stock of 2004 was overvalued. That 10,000 rupees will be added in 2004. Lastly, annual charges for main management charge cost. Every year 25,000 rupees is the management cost. So minus 25,000 for every year. That's it. All the adjustments we have done. Now find out the correct profit, adjusted profit. Take the total 75,000, 85,000, 1,14,000, 1,20,000 to 100. This is the correct profit or adjusted profit. Now, the profits are showing an increasing trend. So we calculate weighted average profit. You can see 75, 85, 114, 122. So continuously profits are increasing. So it is better to calculate the weighted average profit. So profits year 2002, 3, 4, 5. Profits are 75, 85, 114, 122. Weights are given in the problem 1, 2, 3, 4. So multiply 75,000 into 1, 75,000. 85,000 into 2, 170. 114,000 into 3, 342,000. 122, 100 into 4, 488, 400. The total of weighted profits are 10,75,400. And the total of weights are 10. So weighted average profit is equal to 10,75,400 divided by 10, 1,07,540. This is the weighted average profit. It is asking you to calculate goodwill according to average profit by 4 years, 3 years purchase. 3 years purchase is given in the problem. So weighted average profit 107,540 into 3. 3,22,620. This is the value of goodwill. That's it. So first main problem I have explained in complete detail. So hope you are understanding my lecture. So if you are satisfied, give a like to the video, share my channel among your friends, among your group, so that more students can watch the video and enhance the knowledge. Give your comments. Subscribe my channel if you have not yet subscribed, and by the super thanks which is given below my video. Inshallah, we'll continue the next problem in the next video.